Great. So, hi everyone. Thank you for being here today. Apologies to all the robots. I've had to leave. Too bad for them. Anyway, welcome. My name is Gary Coleshill. Thank you for attending this educational webinar. It's the role of annuities in retirement, really, to help you understand how annuities work and can have a very positive impact on your retirement. I am a licensed insurance agent in the great states of Arizona and Connecticut with connections around the country. So if there's anything you'd like to ask me at the end, more than welcome to answer them for you. And we're hopeful that this will be a beneficial webinar for you today. You've got the usual disclaimer here. I'm not a robot either, and I'm in no way employed by, affiliated with, or endorsed by any of the government agencies and the alphabet agencies, the IRS, the SSA, Social Security, or any other government agency. This presentation is not intended and should not be construed as tax advice. I am a financial planner with a desire to help people better understand basically taxes in retirement. The information that we'll cover represents our current understanding of income taxes in general and should not be considered legal or tax advice by consumers. This is just a starting point to make you think about some important topics if you're preparing to retire. So please consult with an enrolled agent, CPA, or attorney before implementing any of the strategies here. This is just an overview. So here's a preview of our main topics today. We're going to open up with a discussion on today's retirement landscape and see how retirement has changed from previous generations. That will then take a look at the key risks in retirement that could threaten your financial security. Then we'll look at the types of annuities and see really why annuities are gaining in popularity. And there's quite a few reasons that you probably didn't realize. Anyway, let's see what else do you have for you. We do have a great gift for you today, actually. At the end of the talk, a survey will appear in your browser when we sign off. And we will basically, when we wrap up, if you fill out the survey, it pops up at the end, and it's pretty short. It's about 10 real simple questions. Then we'll send you over immediately a free 122-page ebook, The New Holistic Retirement, which has some great advice and information for when you retire and can maximize that. So, you may have heard of the old three-legged stool approach to retirement income. Pretty simply, in the past, retirees could rely on Social Security, a company pension, and personal savings to fund their retirement. But people retiring today and in the coming years have, unfortunately, fewer sources of guaranteed income, as employer-funded pensions have given away really to 401ks and Social Security by itself, which is simply not good enough, not enough money for most people to retire on. To address these concerns and meet the challenges of today's retirement reality, the insurance industry offers a unique solution, the annuity. Now, forms of personal retirement assets may include employer plans such as 401ks and 403b accounts, or may include individual retirement plans such as traditional Roth IRAs and traditional IRAs, and may even include bank accounts, investment accounts, annuities or cash value life insurance. And all can be incredibly helpful. With the increased personal responsibility and importance of personal savings, many people retiring today don't have one retirement nest egg, but they have a basket with many eggs in different accounts, such as a 401k, an IRA, a Roth account, or even non-qualified accounts. And the question then becomes, how do I crack my retirement nest eggs in order to fill the income gap during retirement? So what is the income gap? The income gap is represented here and is the gap between your pension or Social Security income and your desired retirement lifestyle. Makes sense, right? So the income needed to fill your income gap often comes from withdrawals or distributions from your personal retirement savings. Now, annuities can be a great solution to fill this income gap, providing retirees with peace of mind with guaranteed lifetime income. So it's time for a little bit of audience participation. Now, I know you just love that, don't you? What do you think are some ways to fill the income gap? You can text your answers to me on 480-208-4366, or you can just use the chat box. Let's give you a few seconds to do that and see what you have to say. Okay, looks like we have a couple of text messages. Could have used the chat box, it's probably easier, but anyway. Charlie in Minnesota. Oh, okay, fair enough, Charlie. Charlie says personal savings. Well, yeah, that's true. That is one way. Anybody else, or is Charlie the only one who wants to speak up today? Okay. Yes, it's just Charlie. Well, thank you, Charlie. Appreciate it. Well, thank you for your response, Charlie. Here are some common ways to fill the income gap. Let's have a look here a minute. See if there's another one here. Investments, yeah, that's very true. That's from, I hope I'm saying this correctly, Kimute. Thank you, Kimute. That's a good answer. Anybody else have one? Nope. Okay. Thank you, Charlie and Kimute. Now, here are some common ways to fill the income gap, and they may include continued working, of course, is an obvious one, not one that most of us want to do, but sometimes necessary. Tap into savings, take minimum distributions from qualified accounts. You could liquidate your assets or positions. That's where your investments really come in. Or you could purchase a commercial annuity. Now, let's just change screen here. There are only 3 sources of guaranteed lifelong income that you cannot outlive. And that's the real kind of the really important thing here is that you want lifelong income that you can't outlast. People living longer than ever. You don't want to end up with your money running out. Now, they are Social Security, an employer pension, and a commercial annuity. That's really it. Now, Social Security is the major source of income for many retirees and is often their only source of guaranteed inflation-adjusted retirement income. But by itself, Social Security often doesn't provide a meaningful amount of secure income. It's just not enough. It's good, but it's not enough money, particularly over the years. It's with things getting more and more expensive. It's kind of got left behind a little bit. The average monthly benefit for a retired worker is $1,355, and the average monthly spouse benefit is $705. So you're looking at a couple of grand there. It doesn't go too far nowadays, even though it is inflation adjusted. And less employers today are offering pensions as a retirement benefit. Therefore, individual annuities from insurance companies are playing a more integral part in providing predictable income and a secure retirement. Purchasing a commercial annuity with a portion of your personal savings can add another layer of guaranteed lifelong income. In this example, we purchased an annuity to provide an extra $15,000 of annual income. And as you can see, the income gap is much smaller with that. A common question amongst retirees is how much guaranteed income should I have? Well, that varies, obviously, but a general rule of thumb is to have enough guaranteed income to cover your basic or essential household expenses, which may include food, obviously, you've got to eat, housing, need a roof over our head, transportation, healthcare, still got to pay for that. Even if you have Medicare, you're still paying money up for that. Healthcare, clothing, personal items, and taxes. Now, this provides a solid foundation during your retirement years. The money needed to pay for those lifestyle expenses in that right-hand column can be paid from personal savings. We're also seeing more efforts from industry groups to get the word out and educate consumers on the benefits of annuities in retirement. Here's a great quote here from Dr. Michael Fink from the Alliance for Lifetime Income. And he says, we're facing the first generation of American workers approaching retirement with no clear idea of how much money they can count on receiving or what they can safely spend from their savings, such as IRAs and 401k accounts, without running out of money. Pretty disturbing, isn't it? Now, there are many hazards that people may encounter during their retirement journey which can threaten their financial security. And many of the financial risks people face during retirement are different than the ones they experience during their working years. Longevity, inflation, and market volatility are three major challenges that many people will need to deal with during their retirement. However, with proper foresight and planning, these threats can be mitigated. Considering all of these possibilities, it's easy to understand why careful planning for retirement income is critically important. Now, good planning starts with having a realistic expectation of life expectancy. Now, longevity is the risk of having a long life. We'd all like a long life, right? But we've got to have money that lasts as long as we do. Longevity risk magnifies the impact of the other risk and can result in outliving one's money, which is a top concern for many seniors, maybe the major one. Life expectancy for seniors has never been longer, and one's mortality is largely unknown. So check out this graphic here that demonstrates average life expectancy. A person retiring at 22 should expect to spend 22 years in retirement, and half of the people surveyed live beyond that. So, yeah, it's pretty scary, really. Now, longevity itself is a key factor in the Social Security decision. Unfortunately, many people underestimate how long they may live. With advances in health and science, many people are living longer. As a result, there's a very good possibility that your retirement could last 20, 30 years or even longer. So here's a chart that shows where a person's life expectancy will be if they're alive at 65. A male living at 65 actually has a 50% chance of living to 87 and a 25% chance of living to 93. So, inflation is also a hidden risk and a critical factor when planning for retirement. It will have a considerable impact on your budget, your lifestyle, and overall planning. Inflation is the general rise in the price of goods or services over time, which can be very damaging to seniors on a fixed income. Over time, the long-term impact of inflation can be devastating and can threaten your ability to maintain your desired standard of living. It reduces your purchasing power, erodes the value of your portfolio, and drives up the need for a higher retirement income. If inflation increases during retirement, retirees on fixed incomes will have a hard time maintaining their standard of living. Inflation may not be noticeable in the short term, but it can have a significant impact over a lengthy retirement. Now, market volatility is the variability and uncertainty of market returns, and it's a significant risk for retirees who rely on their retirement savings for income. The ups and downs of the capital markets pose a threat for those who only rely on their retirement savings for income. Market downturns put additional pressure on the retirement portfolio. The time just before and just after retirement are when people are at their most vulnerable. If you have the misfortune of retiring into a flat or down market, the results can be really painful. It can be quite devastating. This is called the sequence of returns risk. Here's an example that shows the impact of the sequence of returns during the distribution phase. This chart shows the historical indexed returns of the S&P 500 from 1989 through 2008 and demonstrates the impact of the order of returns on portfolio performance, especially when losses occur early on in your retirement. The starting principal is $500,000. The income is 4% of the first year principal plus inflation. The inflation rate is 3.5%, and the annual returns are the actual annual returns of the S&P 500 from 1989 to 2008. Both Portfolio A and Portfolio B have the same starting value, $500,000. They take the same amount of inflation-adjusted income and get the same return over a 2-year period, 8.43%. The only difference is that the order of sequence is reversed. In Portfolio A, we see a first-year return of 31.69%, while Portfolio B starts off negatively with a first-year return of 37%. As a result, Portfolio A soars to 2.7 million at one point and ends up at 1.7 million, while Portfolio B ends up at 63,000 and change at the end of 20 years. So taking the exact same returns and simply changing the order of results makes a difference of over $1.3 million. So quite significant, I'm sure you'll agree. So what is an annuity? An annuity is a contract between you and an insurance company. Depending on the type of annuity, they can offer many benefits for those in retirement. They offer, firstly, lifetime income. They offer a protection of savings, a guaranteed interest rate for fixed annuities, the growth potential of indexed annuities, tax deferral, and access to money. Some of them also provide, can supply nursing home benefits and death benefits for those who are legacy-minded. Now, there are many types of annuities, so it is important to choose the right one for your situation. There are income annuities, either immediate or deferred. There are fixed annuities, which are called MIGAs. There's fixed index, FIAs, and variable annuities. For the most part, variable annuities will be out of the scope of our discussion today, But variable annuities provide a variety of sub-accounts for the annuity owner to choose based on their financial objectives and their risk tolerance. This graphic lines up the type of annuities based on the level of risk. On the lower end of the risk spectrum are income and fixed annuities. These annuities offer a lot of guarantees from the insurance company. As we move right, the level of risk increases, but so does the opportunity for higher returns. For instance, insurance companies assume the investment risk on income and fixed annuities to provide the guarantee. However, the annuity owner assumes the risk with variables based on the performance of the underlying sub-accounts. So basically, you can get higher returns, but they're riskier. It's the way it goes, I guess, in life. So let's look at income annuities. Income annuities can start immediately or at some point in the future. An immediate fixed annuity is designed to generate an income stream within 13 months after it's purchased. The income annuity is one of the original annuities in the industry. Income annuity owners receive a regular recurring paycheck from an insurance company in exchange for a lump sum of money. The insurance company manages both the investment and mortality risk, providing stable pension-like income for life on a very specified period of time, typically to people in or nearing retirement. The premium is held in the insurance company's general account, which is comprised mostly of corporate and government bonds. Income annuities funded with a single premium are often combined with other guaranteed income sources, such as Social Security or a pension, to provide an income floor to cover a retiree's basic needs. Everyone with me so far? Hopefully this is making sense to you. If it isn't and you have a question, let me know. Now, income annuities offer guaranteed income, steady, reliable income, the peace of mind of not outliving your money, as well as customization and convenience. Now, let's compare the three types of deferred annuities using these three graphs here. Fixed annuities offer a guaranteed interest rate declared by the insurance company, but they have lower returns. The returns of variables are directly tied to market-based sub-accounts, which offers the potential for higher returns, but these returns are subject to market volatility and could lose value. You fully participate in both the highs and the lows of the market, which leaves us with fixed index annuities. Now, they have the potential to earn interest based on the performance of a selected market index, and they're between fixed and variable annuities in risk. Terms of risk and return. They offer greater growth potential than traditional fixed annuities do, with less volatility than variable annuities. Now, let's move on to fixed deferred annuities. They're often called MYGAs, which stands for multi-year guarantee annuity. Now, designed for safety, fixed annuities are a good fit for retirees seeking tax deferral and a guaranteed fixed rate of interest, regardless of market volatility. A deferred annuity can help you to accumulate assets more tax efficiently, and when the time is right, convert them into income that you can't outlive. With fixed annuities, the insurance company declares an interest rate in advance of how much interest will be paid. Now, fixed annuities offer a traditional, straightforward design, helping people save and grow their money on a tax-deferred basis. Considered low risk, fixed annuities bring predictable incomes or predictable outcomes by earning a stated rate of interest. They can also be structured to provide guaranteed income. Now, a multi-year guaranteed annuity is a type of fixed annuity. MIGAs guarantee a fixed interest rate for a specified time period, usually 1 to 10 years. They're intended for longer-term horizons and are often subject to surrender charges. However, many carriers do offer penalty-free withdrawal provisions. The insurance company takes on the investment risk, and the premium is held in the insurance company's general account, which is comprised mainly of corporate and government bonds. Now, annuities are tax deferred, which means the taxes on the interest are postponed and not due until the money is withdrawn. This leaves more money in the annuity to grow and keep compounding, which over time can be a tremendous benefit for the annuity owner. This graphic shows the triple compounding that is a result of tax deferral. Now, I'm sorry about that, kind of a glitch there. Now, this graphic shows the triple compounding that is a result of tax deferral. Triple compounding allows annuities to accumulate interest on your principal. Oh, I'm in trouble with the screen here. Accumulate interest on your principal, interest on your interest, and interest on money that you'd normally pay in tax, okay? Now, let's move on to fixed index annuities, sometimes called FIAs. Now, fixed index annuities are unique risk management vehicles that combine the growth potential of index-linked interest, the protection from market downturns, tax-deferred growth, and the guarantees of lifetime income. With a fixed index annuity, the interest that's earned and credited to your annuity is based on the movement of a market index. If the index goes up during the segment period, a formula will be applied by the life insurance company to determine what amount of that gain will be credited. Examples of FIA indices include the S&P 500, the Dow Jones, the NASDAQ, the Russell 2000. Bonds and property indices is developed by insurance companies. Now, even though the underlying index may increase or decrease in value, FIAs have a guaranteed floor, usually 0%, protecting the contract owner against a loss if the index decreases in value. If the index goes down, no interest is earned, but the value of the annuity contract is protected and doesn't go down. So basically, zero is your hero here. Normally, you lose money when the index goes down in other cases, but in this case, you still retain your principal. Now, typically, any interest that's earned and credited to the value of the annuity is locked and cannot be lost as a result of future corrections in the index. Carriers use a few common approaches to calculate how much of the index-linked returns get credited to the contract as interest. There's the cap. The cap is the maximum interest rate that can be earned during the crediting period. If the underlying index exceeds the cap rate becomes the credited rate. There's the spread. That's the margin, the percentage that's deducted from the index return at the end of the crediting period. For example, if the annuity has a 4% spread and the index increased by 10% over the crediting period, the contract would receive a 6% interest credit. And there's also the participation rate. Now, the participation rate, if we can say that properly, is the percentage of the index increase used to determine the index-linked interest. For example here, if the contract has a 70% participation rate and the index increased 10% over the crediting period, the contract would actually receive 7% of credited interest. That makes sense? If it doesn't, stop me and ask me. Once the interest is earned and credited, the value of the contract cannot decline, even if the index returns are negative. The ending value of the index becomes the starting value of the index at the beginning of the next crediting period. Any previous gains are safe. FIA contract owners don't have to regain their losses to get positive crediting during the next measurement period. This helps to protect the annuity value and to smooth out market volatility. Now, here are some good questions to determine if annuities are right for you. Are you looking for balance during retirement? Are you looking for safe money options for your retirement savings? And are you looking for more guaranteed income beyond Social Security? Do you want growth potential without the risk of market loss? How and when will you need the money in the annuity? In addition, features and benefits may vary by product and state because annuities are products of insurance companies and are not guaranteed by any bank or insured by the FDIC. Guarantees are based on the financial strength and claims paying ability of the underlying insurance company. So it's very important to pick a highly rated insurance company. Now, if you like, I'd be more than happy to sit down with you and review your retirement income plan with you, either virtually over Zoom, can certainly do that, or if you're in the state of Arizona, I'll come around and sit down with you at the kitchen table and go through it. So if anybody has any questions, feel free to type them into the chat box now. Or I'd be happy to answer them later if you think of something later on. Let's just move to the last screen here. I'd like to thank you for being here today. If you hang on for a couple of minutes, let's see if I can just make that screen a little bit bigger there. It's blocking off some of the writing. There you go. That's better, I think. Everybody seen that? All my contact details are on there. You can reach me on my cell phone, 480-208-4366, or you can shoot me an email over to garyc at Elite Pro Speakers. Remember that when we wrap in about 2 minutes, that when we actually sign off, the survey will pop up in your browser. And when it does, you will be able to fill out the survey and you'll get your free ebook that we promised. And I think that's about it, actually. Oh, thank you for your nice comments there. Appreciate it. My pleasure. Hopefully I explained that clearly. It's a little bit of a complicated topic, so it's a bit hard to take in all at once. But yeah, if anybody has any questions, More than happy to answer them afterwards. Give me a call. Make sure you do grab that book on retirement too. Just go to that survey afterwards and fill it out. There's nothing on there. If you can't answer a question or don't want to, just put NA on it. That's fine. I don't think any of them are that personal, but anyway, thank you very much for not being robots or Daleks. Appreciate that. And yeah, give me a call if you have any questions. Feel free to call me on my cell phone, 480-208-4366. That's about it. Yeah, thank you. No, thank you for your nice comments, everyone. I appreciate that. I'm glad you liked it. And feel free to join the other webinars that we have. I do them on different topics. A lot are on retirement, to be fair. But there's other things we do webinars on, college planning, various things. Taxes and retirement is a big one. Decisions you have to make into retirement is another one as well. So yeah, I mean, if you want to, just write on the survey, just put in send invites, and I'll send you an invite to each one that we do. You don't have to attend, but I'll give you that option. And enjoy the ebook. I hope you liked it. I think I like it. It's a very good book indeed, and some great tips in there. So thank you, everyone. Appreciate it, and watch out for that survey. Going to stop recording now and sign off. So have a great weekend.